Good afternoon and welcome to the latest edition of the Go Plan 101 Financial Fitness Series. Today's episode is Don't Let the Headlines Fool You. We always like to give a little quick introduction to the people who make these webinars possible. Up top, we have Jamie Greenleaf. Jamie is a partner and advisor with Cafaro Greenleaf. Here with me today, or not with me, but on screen with me, is Jim Hiles. Jim is the managing partner of First Capital Advisors. Hi, Jim. Thanks for the wait. And I am Jim D. I'm a financial advisor with Greenleaf Financial.
So the topic of today is headlines, and headlines. I love headlines. I love the New York Post and all the fun little things that they do. But headlines do grab our attention, and you see headlines like this. Statistics show that teen pregnancy drops off significantly after age 25, and it gets your attention. You read it and you realize, wait a minute, that is ridiculous. That's not what a headline is. That's just silly. But headlines, we are programmed to look at headlines, and then sometimes we actually read what they say. Like this one, for example, breathing oxygen is linked to staying alive. Now, go figure. Who would have thought that? So they get your attention, and the advertisers and the media certainly know this, and we're all sort of conditioned to this. But when it comes to other things going on in marketing, these are things which we've grown up with, at least I have, that we grew up in a time where people, even in this case, look at this guy on the left, the Viceroy Dennis, recommending cigarettes. Unbelievable. And here is, Barbara Stanwyck, who was a model in her day, just what the doctor ordered. So marketing and advertising and the way we're sort of conditioned to think impacts us. And what we're doing in this episode is we're bringing it back to finance. So Jim, why don't you walk through these slides for a sec?
Sure. I mean, we've seen plenty of headlines throughout the dates. This is from 1982. Back in 1982, Business Week ran the headline, "The Death of Equities," right? So talk about sensational journalism.
Yeah, so since 1982, we've had a stock market which gone pretty much nowhere but up. So That was really good.
So if you bought into that, you didn't do quite so well, right?
No, not 2008. So
right. I mean, in 2008, we all remember that one. There was a humongous crisis that went on Wall Street. We saw Lehman Brothers wiped out. We saw Merrill Lynch sold, and AIG was a dirty word.
Right. So you see all this stuff, and if you look at this headline for a second, it almost hits me today, like right in my gut, like I had to do something now to protect myself. I get fearful of what's going on. And I think the point of this is that's what the media is hoping that you do. And Jim, this is a great little story to tell about perception. So go ahead.
Yeah, I love this slide. This is from Daniel Kahneman's book, Thinking Fast and Slow. So think fast, everyone who's watching this. If $1.10 will get you both the bat and the ball costs 10 cents more than the bat, very quickly, how much does the ball cost? And most people, right. The very easy answer, the very fast answer is the ball costs 10 cents. And it comes very naturally. The problem is that answer is wrong because you were thinking fast and it seemed obvious. But if the ball costs 10 cents and the dollar costs and the bat costs $1 more than the ball, then the bat would be $1.10. And then you would have $1.20, right? So the ball costs a nickel. And if the bat costs $1 and a nickel, you have $1.10 for both. Gotcha. So take your time and think about that later. I had to read that passage in the book several times before it sank in.
And it kind of goes to the whole thing here about how we're conditioned, right? I mean, this is looking at ourselves and actually inside the human brain in terms of how it works. Once you kind of understand what's on the slide, why don't you walk through this, Jim?
Sure. Marketing and headlines are designed, they're created to make us use our prefrontal cortex, right? Under stress or in a hurry. We don't want to think, actually, we do want to use our prefrontal cortex, right? Instead of, right. So when in a perceived threat, the amygdala is what kicks in. You can call that the lizard brain. So if, you catch somebody with a thinking fast situation like we just saw, or a perceived threat like somebody screaming in your face, as we see there, which never happens to either of us, right?
I don't know how you got my wife on this.
No, never. Dean would never do that. And perceived threat, something like a tiger, obviously any kind of a threat is basically kicks into our amygdala. It's our thinking fast brain, and often our thinking fast brain gives us the exact improper response, the wrong
Right. So
response.
that the fight or flight is another word you hear, or another phrase you hear a lot about that part. It's like it gets a reaction. Essentially, that's what it's designed to do. The brain is designed to fight or flight, get a reaction, and make decisions quickly. And it's been programmed. But when we see something like a headline, that's the reaction that we're given. Because the other thing interesting to note is that when they did the studies, and you look at Daniel Kahneman's book on this, Thinking Fast and Slow, you look and understand that it just takes more time, energy. It's harder to think through things. So that's why these headlines tend to stick like this.
Right.
Take us through this one. This is a classic.
Yeah, these are headlines that some of us saw. Some of these, probably nobody on here have seen all of them in real time, but back in 1914, the headlines were running things like the world was running out of oil in 10 years. So in 1924, the U.S. Bureau of Mines said we were going to be out of oil. And then in 1950, the U.S. Department of Interior published the world will run out of oil in 13 years. Then we saw the world will run out of oil and other fossil fuels by 1990. That was in 1973. And back in 2002, as early as 2002, and Beyond the Limit, the headline was the world will run out of oil in 2030 and other fossil fuels by 2050.
Amazing, right? And I remember these days. Dates me a little bit. That's not my car, by the way. But I remember when we had a gas,
the gas
embargo, oil embargo, and the whole thing was you had to get in line to get gas and such. So those were days where it actually helped this myth. And you wonder sometimes where these are coming from. You get all kind of conspiracy theories like, wait a minute, this is the oil companies, jacking up prices. Who knows? It may have been, but look at it today. I mean, the world is awash with oil. There's more oil than we know what to do with. Matter of fact, in 2020, because of COVID, it's actually we're sending stuff back to where they came from. So it really just does depend. How about this one, Jim?
Yeah, I mean, remember Enron. So I'm sure most people on this webinar can remember when Enron was the darling of Wall Street. Here we have a cover of Worth magazine, the 50 best CEOs. And we had Jeffrey Skilling, the CEO of Enron, right on the cover. Fortune magazine, America's most innovative company for 6 consecutive years from 1996 to 2001. And Fortune magazine had Enron ranked as one of the 100 best companies to work for. It was Enron was the darling.
Ouch!
A few years later, the headlines changed. Everyone who owned Enron was burned. There were books written, Power Failure. There's others, the smartest guys in the room, and there's the Houston Chronicle, guilty, both.
Yeah,
president, CEO.
That's tough. So I guess don't believe half of what you read.
Right. Headlines change. So
as humans, we are, emotional creatures, and there are things like FOMO or fear of missing out, which have also created some problems. And that has a little bit to do with, our desire to be part of something, to be in the thing. So Robinhood, for example, is a more recent one where, it was really easy to look at a headline and think, hey, guys, we're making money here in this Robinhood. Let's go buy stock, go buy this stock, go buy that stock. We're going to make, literally $1 billion. This is easy. We should all be doing this. And, unfortunately that is not necessarily how you should invest money. And if you want to learn how to invest money, go to GoPlan101.com and learn that, because unfortunately there is no free lunch. There never has been. There never will be. Tell me about impulse buying, Jim. Tell me about your impulse buying. What were we going to buy again?
I almost made an impulse buy.
You almost made an impulse buy.
Talk about that later. Yeah, I was able to squelch the impulse for the time being.
Okay, good. Let's see how that works.
Humans have some humans, not all humans, have a love of shopping, and for some, buying something new can create a feeling of empowerment and control over your life, and that can become addicting to some people. We also have, that feeling. A lot of people have the feeling of there's limited time where, and that's why we see these sales that won't last long, and people oftentimes respond to that with an impulse buy. And there's also the loss aversion is another theory as to what drives impulse buying. And that's, people try to make decisions that will keep them from feeling bad or regretful in the future. So they lost out. They didn't take advantage of it, and they go home and they have the opposite of buyer's remorse. It's non-buyer's remorse.
Right. And there's a lot of, there's a lot of it comes from one of these devices, right? I mean, how many times, you look at your phone because you're hoping to see or hear, or maybe you hear the ding on Instagram, you want to go see it and send out your funny message to somebody else just to be part of the crew. It's an interesting thing that we're all dealing with this human brain. So here's some interesting, advertising again has a lot to they get this, don't they? The marketing guys get this. The people who sell media get this. Here's some good ones. Jim, take us through this.
There's some very expensive Hollywood stars on here getting paid by credit card companies to endorse their product, right? And get people to buy, whether it's either celebrity endorsements or it's an enticement like 80,000 bonus points for signing up for a new card. There's all kinds of rankings out there, the best credit cards. I mean, US News, that as if that's a news story, right? Like, here are the best credit cards that available to you today. And here we, down at the bottom, I don't know who that guy is. He looks like, I think he's the guy from Game of Thrones, but I'm not sure.
I'm thinking with a beard like that, he better be. That's a good looking beard.
And then the other one is the Apple card, right? I mean,
right.
People want to get the Apple credit card because it's cool and it's Apple.
Right. But
where does that lead?
I thought they paid me when I was joining. What's up with that?
I thought, right. Everybody gets these cards. They're getting 80,000 bonus points. That sounds like they're giving money away, right? And then next thing you know, you're saddled with a ton of debt, and you're looking at interest rates that should be, in my opinion, illegal at this point, because we know what you're earning on bank account balances and interest rates being at record lows, but yet credit card companies are still making a lot of money.
Careful, people, careful. If you need credit card help, go to GoPlan 101 and get some help with that, because that's a problem.
Right. They don't count on people paying their balance every month, needless to say, because those people that do are few and far between.
Right.
And the rest of those people are the ones who win.
Well, here's behavioral bias. This is a sexy word, because that's really what we've been talking about. Behavioral bias. Behavioral bias is basically studies have been done around this about there's much more incentive to avoid loss, essentially, than to be motivated for pleasure from gain, and that's called loss aversion. So, we've all kind of been there, I think, on this. And some real life examples are, if you've invested any money, whether in Robinhood or not, you probably have experienced this in your 401k account or whatever. Whereas when the markets are going up, you feel confident, you're positive, and you get to this point where, and maybe we saw some of this in the last couple of months, it could be that we have seen some overconfidence with the Robinhood type of situation. But investors at that point tend to buy because everything feels good, and they buy high. They're doing the exact opposite of what they probably should do. And then when things start to go the other way, which they always do, that we are in a cyclical economy, markets go up and down, that's just the nature of the beast. All of a sudden they're surprised, they're nervous, they're panic stricken, then they feel defeated and they just give up and they sell. And that's the exact wrong time to make financial decisions. And right there is where you see those 2008 headlines, those 1987 headlines, the death of equities. Everyone says, I'm getting out of this thing because they're dying. We can't make any money here. Well, the reality is that's not true. And here's kind of simple math as to why you should avoid this, because when you have money, and let's say it's invested in anything, it's worth $1, and it goes down 50% to 50 cents, the rate of return, the pure math of this thing to get back to your dollar is not 50%. It's 100%. So you want to be very careful about selling at a bottom here, because getting back to where you started is going to take a double, in this case, rate of return than it took to get here. So be careful about the math. This is something when we talk to people about investing and there's bad news, we call it volatility in the market, up and down in the market. If you're a long-term investor, forget about this kind of thing. It's going to happen to you. Jim, tell us why. Here's some good examples.
Right. The impact of getting out. If you look, this is a little bit of an eye chart here, but we can see that the impact of getting out is then the stress isn't over. People get a sense of relief when they get out. They feel like, okay, I'm out. I'm not exposed to volatility anymore. But then they realize that at some point they're probably going to have to get back in, and then all sorts of questions are raised. When do I wait? How long do I wait? At what point do I get back in? When is the volatility over? When is it safe to return?
Right.
I mean, I hear this a lot. We hear this in real life, right? So, this is just an example of having missed someone who stayed fully invested.
Right.
Left.
Right.
Stayed fully invested through the dates that, what is that?
10 years.
Right. So for that 10-year period, you made the
20
most
years,
amount of
my
money.
bad. 20 years.
20 years.
20
right.
years. So if you stayed invested for 20 years, you're going to get 8%. If you just miss 10 days out of 20 years, you're going to get half the return.
And the trick there is that the best days come
Right.
very close to the worst days, right? We've seen,
Yeah.
How many times have we seen that in the past 2 or 3 months now?
Yeah.
We've seen some of the biggest returns on the S&P or the Dow Jones, whatever you see on the news. So those biggest days on the upside have been, back to back with some of the worst we've seen. So.
Right. So if you're investing, truly investing, and we should be investors to make money, we got to think of the reason for being for the money. If it's 10 years from now or 20 years from now or longer, really think this way. Don't try to time markets. It generally doesn't work because this has happened for a long period of time. Our economy has overcome our negative bias in the media and advertising. And you can sort of look at this slide and you can pick out historical times, historical events, both good and bad, what could impact people in terms of making decisions. Most of the time, not the right decision if you look at it purely from a headline standpoint. I mean, just pick any one of these things. In 2010 flash crash, the market's going to go down. Well, from 2010, to today, you would have missed out on a huge, probably one of the biggest bull market runs in history. So I think when you look at it, Jim, take this one a little bit. You have to understand the market that we're in.
The good outweighs the bad over the long term, right? So there's no rhyme or reason to when the negative years are and when the positive years are. So if you think you can pick, you might as well go to Las Vegas or Atlantic City. But most people can't. No one can. Right?
Exactly.
We know that.
So just to go through this eye test, this chart says that positive are over to the right there, this way. And those are years. Those are positive years. So each of those blocks in there is a positive year. And to the extent that they're positive is a number on the bottom. So you can see that, the majority of the years, this goes back really a long way. This goes back into the 1800s that they studied, and consumer behavior or human behavior has been around for that long too. So we are going to probably have, more likely than not, a continuation of this because robots haven't taken over everything yet. And we're still human. So we think this is what you should be looking at, particularly when you're talking about investing money. Of course, the thing that freaks me out the most is running out of chocolate. I mean, this really got me going. This is
that headline. I will vouch. That headline sent Jim Hiles. I think it gave him hives.
I mean, 2013 was a horrible year. We were going to run out of Coke in 7 years. There's going to be no more chocolate. That's horrible. We don't want to do that. So
ignore that headline. Here we have the psychic who was arrested again and still didn't see it coming. That's just
So, love the headline. I guess you didn't see this coming, but we're at the end of the show. So Jim, why don't you wrap this thing up?
So our point here is that headlines and media are designed to make you think fast and make decisions under stress or not optimal conditions. We're trying to encourage people to think slow down, make your decisions, especially when you're in a stressful time like now. Take your time, think things through, and that'll help you make more rational decisions. If you need help, use GoPlan101.com as a resource. There are resources on there. There's articles, there's material, and you can always contact us. We always make that offer for a free consultation at that phone number, 732-945-7472. Feel free to email me directly at jd@gfplan.com. And remember to join us for our next webinar, which will be Tuesday, August 11th, 2 p.m. as usual, where we'll talk about the Fed and why you should care.
A lot of good headlines about the Fed, so maybe we can talk about that too.
Yeah, what's the Federal Reserve? What is it?
We'll see you then. Take care.
Thanks. Have a great day.